What's going on, guys? In this video, I'm going to show you the 5 most common order types in the stock market. Now, when you're either buying or selling a stock, there's different types of orders that you can set up, and the 5 that I'm going to be going over are market orders, limit orders, stop loss orders, sell limit orders, and trailing stop loss orders. If you're just starting out with investing, knowing these 5 order types can really help you along the way to boost your profits and mitigate your losses. Now, first, I'll show you an example of each order type on the computer and try to explain it the best I can. Then I'm going to jump on to TD Ameritrade on my phone and show you exactly how to set it up. And we're going to dive right in, but before that, guys, smash the like button and subscribe if you haven't already. All right, the first one we're going to go over is a market order. So a market order is pretty self-explanatory here. We see the stock going up and down. You want to place an order at its current market price. It is just going to fill for whatever the current asking price is. So you can see we just got filled in this example right here. You see this green target represents where we got filled for. So whatever that asking price is, regardless of slippage, you're just putting it in and it is buying it right then and there. You may not get the best price that you're looking for, but that's the downfall of a market order and why I wouldn't necessarily recommend it. Now, as the stock goes up and down and you want to finally cash out, you're going to cash out with a market order as well. So same thing, is going to get filled for whatever the current asking price is. And you can see in this example, it got filled right here about $235.97. Little bit of a loss. That's market order. So now we're going to show you on TD Ameritrade how to set up a market order. All right, so here's one of my TD Ameritrade accounts. Doesn't matter if it's a 401k, an IRA, or a regular brokerage account. They're all pretty much laid out the same, and buying and selling equities are going to be virtually the same. So we're going to hit up at the top, trade, and we'll go to Verizon. So Verizon is right now $52.40. We want to put in a market order. So our action over here is set at a buy. And then if we jump over to type, we're going to set it at market. Now there's really not much more to put in except for the amount of shares. So let's say 1 share. Our expiration, so we could do day or MOC. For this, we're just going to hit day, which is pretty simple. As soon as the day closes, if you don't get filled for your order, which is very unlikely to happen if it's a market order, then it will close out. The only way that it wouldn't actually fill is if there's any kind of liquidity problems with that stock. And then special instructions, there's really not much we can do here because it is a market order, so there's none. So we're going to hit review, and then before we hit place order, you can double check your work, make sure everything's set. So we want to buy VZ, which is Verizon. We're buying 1 stock at the market price. Our expiration is day, routing and exchange. You don't have to worry too much about that. Position quantities, make sure you put in the right amount. So for this, we have 1. And then here is an important little risk note. How a stock could change price very quickly and you may get filled for an undesirable price. That's why market orders aren't typically recommended. I've heard horror stories of people trying to be filled for one price, but then it jumps up in the complete wrong direction and they get filled for a much worse price, and then they have to live with that. But other than that, just make sure you have enough buying power, and then you would hit place order. And then your market order, as long as the stock market is open, should fill instantly. It's going to fill for whatever the current asking price is. And then simple enough, if we wanted to do a market sell, we would just flip it on sell. So let's pretend we already had 1 share of Verizon and we want to sell it. We have our order type at market, 1 share, day expiration. We hit review order. Double check your work again to make sure everything's right. Then we hit place order, and that will automatically sell your shares at the current asking price. All right, next on the list is limit orders. This is the order type I use probably 99.9% of the time. So before we even play the video of the chart going, you can see right here, we have a limit order set for $207.17. So what that means is it will not fill unless the price goes down to that 207.17. Currently the price is at 215.86, so the order is staying open. All right, so we're watching it play out, and we're gonna pause it right here. You can see we got close with this candlestick. We got close to our limit order, but it didn't quite go all the way down to where we wanted it to, so it didn't get filled. This happens pretty often, but that's the point. You don't want it for anything higher. You're selecting the exact price you're looking to get in at, so it's not gonna fill until we hit that price. So it didn't get filled. All right, we're letting it play out, and we'll pause it right here. You can see it was filled at that price or better, in this case lower, because we're trying to buy. So it either got filled for the 207.17, or maybe it's a little bit more favorable and it was 207.16. An order limit will never fill for a higher price than what you set it at. That is the point of limit orders. All right, so next we have a limit order. First, we're gonna go over what a buy limit order is. And this is something that I use on every single trade. I would recommend everyone to use this type of order type, but we're gonna go to Verizon, and TD Ameritrade already has it set for limit because that's just best practice. And to me, I would say it's the safest route to go. So we're gonna do buy limit, the amount of shares, we're gonna say 1, and now we have down here a price. So we're gonna punch in what limit price we want it to trigger for. The current price is $52.40. I'm gonna keep it at that if I believe that that's a fair price for it. And then we're gonna do day, and then special, we're not gonna really change anything. We're gonna hit review, and then we could go over it. So we got Verizon, 1 share at $52.40 limit. What account it's from, position quantities, make sure it's the right amount. And then when we hit place order, you can see right here it says open. So it says open limit because the market's closed right now as I'm recording this, but it will stay open until Verizon were to hit $52.40 or better, which in this case means lower. So it could get filled for that amount or lower. If it isn't at that amount, let's say it's $52.41 and then it keeps going up, I won't get filled, but that's okay because that's the purpose of a limit order. You get filled for the price that you are comfortable paying for and not a penny over. All right, so moving along to stop loss orders. It's very similar to limit orders. It's the same concept here. So we bought in and the stock's going up and up, but we're gonna pause it. You may notice we have something called a stop loss order, which is right down here at $195. So this is gonna help us mitigate risks. If the stock starts to go down and goes all the way down to $195, it will end up selling for that $195 price. So we're gonna let the stock play out, and sure enough, it spiked all the way down to that stop loss order of $195, and we could see that we ended up selling at that price. Now, unlike a buy limit order, sometimes a stop loss will have some slippage, and it may not be the best price. That's because markets aren't perfect, and especially because you see these gaps. Here's a big gap here, a big gap here. So sometimes a stock will end up gapping further below your stop loss, and you actually may get filled for a worse price. But in this example, we'll just say we got stopped out exactly at that $195 that we were looking for. All right, so next we're gonna be going over stop loss orders. So they're not exactly called stop loss orders on TD Ameritrade, but they're pretty much all the same thing. I'm gonna show you exactly what they are in 1 second. So let's click on one of the ETFs that I have, VTI. Let's say I wanna sell some, whether it be the entire position, every share that I have, or a certain amount. So let's do reduce position. We'll say 1 share. So I want to sell 1 share, but when we go to the drop down, we have 2 options here. The only 2 stop orders we have are stop market and stop limit. So let me click on stop market really quick, and you can see we have something called an activation price, which right now is $242.57. But now let's drop down, let's hit stop limit and see what new field we get. So now you can see we got price and then activation price. So similar to regular market orders and limit orders, the best practice would be a stop limit, because if we just have a regular stop market, as soon as it hits that activation price, it'll get filled for whatever the ask is, and it may not be a preferred price. You may get slippage and you sell it for a worse price than what you were planning on. So because of that, we're going to do a stop limit, and then our activation price, we could pick exactly what price. We'll say $230. And then for our actual price, we'll also say $230. So pretty much what we're saying is it's going to activate as soon as the price drops down to $230, and then it's going to turn into a sell limit for that $230. So then we're going to hit review order, and then again you can go over everything, make sure it's all right, the position quantity's right. So it shows me my current holdings and then my estimated after trade, so it'd be down 1 share. The same risk warning is coming up with stop market, but that's okay because we have a stop limit. And then if I were to hit place order, you can see right there it says stop limit at $230, activation price $230. All right, so now on the upside, we're going to be going over sell limit orders. A sell limit order is a good way to take profit when you're away from your computer or hit that certain target price automatically. So we need to re-enter into a trade. So we're going to keep the chart that we have, and let's say we buy back at that 207. So here we are, we just got filled for 207.17. Or better, which in this case would be lower. We'll just say it was at 207.17. And before we let it play out, we're actually going to lower our stop loss a little more to 182. And then we're going to have our sell limit at 275. You could have multiple orders on one stock. So if the stock goes below 182, it is going to sell for a stop loss, and we're going to take a loss. But if it goes all the way up to 275, we have our sell limit set, and that is where we're going to be taking profit. So let's let it play out and see what happens. And look at that. We end up hitting almost the very top. We almost called the top in this case, and we get sold for that 275. And you can see right here, we will get filled for 275 or better. Just like a limit order, our buy limit order, we're going to enter the trade whether it is at that desired price of 207.17 or better. But when it comes to a sell limit, we're going to exit the trade at 275, whatever our sell limit is, or better. In this case, it would be higher. All right, so now we're going to go over a sell limit order. So back on TD Ameritrade, we're going to click one of the ETFs that I already have. I'm going to hit reduce position. We're going to select one, make sure it's a sell, and then limit. That's already done. So then for price, the current price that it's trading for, you can see up at the top, kind of the top left-hand corner, it says $242.63. We can see our ask and bid. There's a little bit of a spread. $242.57 is the bid, and then 69 cents is the ask. Let's say we want to hit $250. We think maybe over the next couple of weeks or maybe even days it will reach that price. So we're going to hit done, and let's just make sure everything's right. So we got sell action, type is limit, 1 share at the price of $250. Now, if you're day trading, you would keep expiration at day, but because we're not, I'm going to change it to good till cancel. And then it even allows us to pick a date. So we can say, hey, cancel this after April 29th. So we'll keep it there. You can change it to whatever you want. We're going to hit review order, and then you can see our expiration is good till cancel. It shows the expiration date. Position quantity, we're going to be selling 1. We're going to hit place order. And then you can see right here, it's open. The current market price is $242.60, and our limit sell is for $250. Because we're selling and it's a limit order, it is going to sell for $250 or better. So in that case, it's going to be $250 or higher. All right, now it's time to go over trailing stop loss orders. This one's a little bit more complicated, but it can be very useful for many different traders. All right, so here's our setup. You can see we have a trailing stop loss at $30. So it's $30 less than what our current buy order is. So our limit buy is 210, and our trailing stop is 180. Let's let this order get filled. And there we go. We are now currently filled for that 210. You can see the order was filled at $210. And now we can watch the stock trailing down. I'm going to pause really quick. You can see the stock is trailing down, but the trailing stop loss isn't moving. That's because it is always going to be $30 less than what the highest price was, and in this case our highest price was when we ended up entering the trade at that 210. So it's staying at that 180. The stock could trail all the way down to 180 and end up selling at that price, but that's not what's going to happen in this case. So our trail stop is at that $30. This will never be less than 30. So let's play it out. All right, let's pause it right here. You started to see the trail stop loss move. So the actual thing started to move, and that's because our new high, our new local high from where we bought, is now at $225.90. So we ended up buying at 210, but then the stock started to go up, and that's what pulled the trailing stop loss order up. And it is now $30 away from that new high, which is $225.90. So $225.90. So the trailing stop loss order is now at $195.90. Let's let this trade play out a little bit more. And you can see we started to come down, but the trailing stop loss has not moved. That's because the same rules apply. The local high is right there at that $225.90. So this is staying at that $30 trail, that $195.90. The only way this will start moving up again is if the stock breaks through that $225.90 mark. So let's see what ends up happening. All right, and you can see it goes right through that current price, and we're going to pause right here. We can now see our trailing stop is above the limit buy order. This is the profit zone, because if it ends up going back down, we're above what we bought the stock for. We bought the stock for $210, but now our trailing stop is all the way up to $218. This is great if you're at work, you don't have time to look at your stocks, and you don't want to lose any profits that the stock may have made. So that's when trailing stops really come into play. All right, and we're just going to pause right here. You can see we got very close. This candlestick was actually like 2 or 3 pennies off of the trailing stop loss order, so nothing ended up getting filled. And we end up going higher, and now we're coming down to a retest, and there we go. We now sold, or we were stopped out for that $259.23 mark. So that is definitely way above what we entered the stock for, and we didn't even need to monitor this trade. The trailing stop loss order automatically moved that stop loss up as the trade went in the right direction, and we were able to sell for that profit. All right, so now let's jump onto the phone and go over how to set up a trailing stop loss order. All right, now it's time to go over a trailing stop loss order. So we're back on TD Ameritrade. Let's say we want to close out one of our positions. We're going to hit close position, or like I've been doing all the other ones, reduce position by 1 share. So we're going to sell, and then we're going to jump over to here. Now we have 2 types. We got trailing stop percent and trailing stop dollar. I think they're pretty self-explanatory. We're going to hit trailing stop dollar, and then you can see it gives us the shares which is already won, but then right here it says stop dollars. So at $1, this is saying that it's going to sell if it goes down by $1. Let's say we want to have the trailing stop at $10. So we're going to hit done, and then you can see our estimated total. It would sell right now for $232.57. We're going to hit the expiration till good till cancel. We'll keep it at April 29th. We'll keep it there. So we're going to hit review order. We're going to hit place order. And then you can see right there we have a stop loss at $10. The current price is $242.60. So if the stock just plummets over the next couple of days and never reaches anything higher than $242.60, it will sell for $232.60. If the stock goes up to $300, it just shoots right up, and then it retests $10, then it'll end up selling for $290. And then percentage, that trailing stop will just be a certain percent if we chose that option instead of an actual dollar amount. All right, so now you know the 5 most common order types. Hopefully this video helped you and you better understand what you're doing when you're buying and selling stocks. If you like this video, guys, remember to smash that like button and subscribe if you haven't already. And as always, I will see you guys in the next one.